draft and then your memos. And then on Thursday, we have the lineup for the Goldman Sachs presentations. Make sure that you bring me a draft of the presentation. Can you go ahead? Are you recording? Thank you. Make sure that you give me another draft of the presentation on Thursday. Black and white, one slide per page, stapled in the upper left-hand corner, because I'll be going over it again. And I already sent you my office hours, so you know when I'll be in my offices to be able to provide you with any follow-up input up until Thursday, and then up until next week, which will be the final. If you're still struggling to catch up, and you can't meet the deliverable 3 or any makeup, deliverable 2 or 1 during the final period next week, I will be in my office for late submissions on Thursday at 12 o'clock in my office. And then the late show with James Corbin deliveries to me at the Metro from 1 to 3. I'll be there, and then I have a speaking engagement that night, so I have to leave right at 3 to beat the traffic to get to the speaking engagement. And then I won't be back on campus for a while, so you want to make sure that you get those to me. Okay, and I think you have plenty of time. You got something for me? Yeah. Thank you. So let's do quickly the, okay, perfect. Perfect, thanks. And let's do the market updates really quickly. It's been an extremely volatile month. It's been a volatile 2 months. It's basically been the worst stock market environment since 2011. You remember 2011, it was pretty bad. We were coming right out of the Great Recession at that time period. The trade wars currently are basically impacting global GDP. And since most of the other countries in the world are emerging markets that rely on export-oriented growth strategies, if the global economies are decelerating and you have trade wars with China, it will totally disrupt the supply chain. I think Apple's down significantly because they rely on China to source most of their electronic components. So that's having an impact on the tech sector. And then the thing that I fear is that if these emerging markets aren't generating enough export growth and exports, they're not going to be generating enough dollars to be able to pay off the dollar-denominated debt. And once the emerging markets start to default, there'll be contagion in the marketplace and could lead to a global financial crisis. Nobody's forecasting a recession within the next year, but there's a higher probability of one in 2000. I was forecasting a significant drop in the stock market at the end of 2018, which means my forecast has been pretty much materialized, and I'm not forecasting a recession in 2019. Maybe 2020, that's consensus by the economists, but definitely 2021 through 23. So that gives you some strategy. Okay, so let's do the Dow. Where's the Dow today?
Down.
How many points?
50.
50? Okay, I think it was down like 250 this morning. To what? 26?
24,590.
24,590. Okay, so we've lost about a couple thousand points since the last time I've looked. Where is the price of oil? Price of oil is actually in a bear market. It's contracted significantly. It's going to impact Russia, Venezuela, and other oil exporting economies. It's good for the consumer, bad for the stock market, since a significant portion of market cap on the stock market is made up of oil companies, which had seen all-time high oil prices over the last 24 months, and now you're seeing a drop-off in oil prices, which is significant. And where are we today in oil prices?
50.8 approximately.
And where were we last
Down.
summer? Where were we in the summer? Trading at what, 70? So what's the percentage
Got
change?
up to 73.
So what's the percentage change between 50 and 70? How much has oil dropped in less than a year. Can you do the calculations?
There's 30%.
So 30% drop in oil prices, that's significant. And oil prices are really volatile too.
It's actually since October 1st.
So that's not very
Yeah.
far, that's a lot. Where's gold trading today per ounce?
Down 9 points. Trading at 1,200.
Is there are you seeing any type of trend in the gold prices? Is it up, is it down, where's the trending, is it in a trading range?
It's down.
Yeah, last winter it was down, or a month.
Okay, which could be an indication of deflation or disinflation, which could be an indicator, a forward indicator of a recession, because it's a commodity. We're at 10-year treasury yields, yielding today. The 10-year treasury yield has inflation expectations embedded in it, so it's a forward-looking interest rate that gives you a good indication of where the economy is going.
It's down.
305.
305. And where was it earlier in the semester? Didn't it get up to like 325 or 323, or what was it? What was the high on that?
323.
323. So long-term interest rates have been going down. What does that do to long-term bond prices? Does it drive them up or down? Okay, hold on a minute. If interest rates, long-term interest rates are going down, what's the direction of the bond prices, up or down? If interest rates go down, bond prices go
Up.
up. Got it. Okay. What about the U.S. dollar? U.S. dollar to euro, U.S. dollar to pound.
The pound is 1.273.
So it costs us 1.273 to buy a pound. Where was it last week or 2 weeks ago?
It's been going down.
Has it? So so basically the dollar's appreciated and the pound is depreciated because of the Brexit. I guess Theresa May basically says that they can continue to do a clean Brexit. Nobody believes her. Her government is actually in jeopardy, and if she gets a no confidence vote, she'll be kicked out. There'll have to be new elections to form a new government, which would be pretty significant for the UK. Where's the dollar to the euro?
That's down to 1.13 approximately. It's
So the
down
dollar's appreciated and
a
the
third
euro's
of a percentage.
depreciated.
Yeah.
Okay. A lot of capital flows coming into the United States because interest rates are high here compared to other countries, and the unemployment rates are really low, and job growth is still relatively healthy. So the prospects for higher returns on real estate and stocks are still pretty good here compared to other countries. So lots of capital flows coming in. I'll do the options presentation. So chapter 20, nobody presented this, right? We did all the other presentations except for this, which is kind of serendipitous that we're ending with the option presentation, since I led with the options right off the bat in the class with the memos, okay? Because it's the hardest subject matter to comprehend, so I decided to bring it up front, in the class, so that by the time you get to this point in the class, you should be very comfortable with how to trade these option contracts. So what we're going to go over is just some review of the option contracts. And the option contracts are financial securities. These are derivatives. Okay? So they're not stocks, they're not bonds, they aren't securities, and they are traded on exchanges, but they're traded on commodity exchanges, not stock exchanges. So the options are a derivative of some kind of underlying. Okay, the forwards and the futures contracts are traded on an underlying index, or the futures contracts are traded on an underlying index or some underlying commodity index, or the futures contracts are traded on some type of option contract. Okay, so it's some type of derivative of some type of underlying. Okay, and the prices of the option contracts and the prices of the forwards and the futures contracts are not perfectly correlated to the spot prices or the underlying indices, so there's always going to be some type of what we call basis risk. But just as long as there's strong enough correlation between the option contract prices and the underlying prices, you can use the option contracts and the derivative contracts to either take exposures within those markets, or you can use the derivative contracts to hedge off market risk, which is why we use it. And everybody uses derivative contracts. So if you go work for any major corporation, you go talk to the people in finance, people in treasury, or any other proprietary trading unit within the organization, they use derivative contracts actively to be able to hedge off market risk that they're exposed to, either currencies, interest rates, oil, gold, whatever their exposures, they can hedge that off. There is an expiration date in the forward contracts. There's contract expiration dates. Forward futures contracts, there's standardized expiration dates. Forward contracts, they're customized expiration dates. And then the option contracts run for 3 months during the year. So January, February, March, April, May, June, July, August, September, October, November, December. Okay. So you basically 4 option contract periods to be able to buy or write these contracts. There's going to be an exercise price, and then there's going to be a spot price. And depending on if you're writing or buying the contract, you could be in the money. If you write the contract, money goes into your pocket. If you buy the contract, money goes out of your pocket. Okay? And then it really depends on the direction of the indices or the underlying spot prices. Call options is basically the right to buy. So here, this is a pretty good example, but I went through this earlier, is you have to pay a premium, okay? And then as the stock price goes up or the index goes up, once you reach the break-even point, you're going to be in the money. And that could be called an in-the-money call option. If you write the call option, you're going to make money when the prices go down. And since you wrote the contract, the money goes into your pocket. If the price of the underlying does not move significantly above or below the exercise price, the contract will expire worthless, and you get to pocket the money if you wrote the contract. Okay. The put option is where you make money when you think the prices are going to go down. So we can make money if prices are going to go up. We can make money if prices go down. It doesn't matter. And the put option, again, is there's an exercise price. If the price goes down, you're going to make money. If you write the put option, you make money when the prices go up. So that's all you have to do is memorize. When prices go up, I'm going to buy a call option. When prices go down, I'm going to buy a put option. If prices go up, I'm going to buy a call option, or I'm going to write a put option. If prices go down, I'm going to buy a put option, or I'm going to write a call option. You memorize those combinations. Okay. And then the value of the options, as we talked about earlier, are going to be a function of the volatility of the underlying stock price or the index. The volatility adds to the value of the option. The time period, the longer the time period to expiration or expiry is what it's called. There's more time value in the option, so it's more volatile. I mean, there's more time value to it. And then there's what is called an American option and a European option. The American options allow you to exercise the option at any time period within the option period. The European options only allow you to exercise the option at the end of the time period. That's the distinction between the two option contracts. So it depends on if you're working in Europe, you'll be trading European options. If you're in the United States, you'll be trading American options. So we talked about volatility, we talked about time, we talked about underlying. There's also what is called the put-call parity, where the value of the put option is equal to the value of the call option, plus the exercise price, e to the minus r to the t. This is basically your risk-free rate minus the value. So this is an identity here, and if any violations of any of these components of the identity are in place, if you can identify these in your options trading, you can create arbitrage through mispricing. And a lot of these option contracts are extremely liquid, so if you can identify through some type of trading, a quantitative technique, some kind of arbitrage opportunity, you move extremely quickly because the market will pick it up at some point and the arbitrage will go away. But there's a lot of options traders out there that make a lot of money trading these options and utilizing the quantitative techniques behind the violations of these identities. And here's just an example of the put-call parity. You got the call plus the exercise price, and you got the risk-free rate minus the value. It's going to give you the value. We also talked about real options a lot in this class, particularly during the second third of the class when we got into capital budgeting. It's unfortunate that they decided to put the real call option valuation, application, and augmentation to investment decision making, such as the net present value, and internal rate of return calculations. They apply the real call options too late, in my view, in the semester and in the book, where it should be brought up to the front and actually used in the capital budgeting chapter, because it's more theoretically correct than putting it as an augmented theory, in chapter 20 of the book, where it should have been in chapter 6. But real options are options on real assets such as real estate, or companies, or biotech products. It's an augmentation to the net present value calculation, and if you get a negative net present value, you calculate the real option, and if the real option value is either equal to or greater than the negative net present value, your net present value is 0, and therefore you accept the project. We went through all of that before. There are different types of real options. Deferring the investment. Management has the decision to defer the investment within the development or within the company or the biotech product. That ability to defer, or that decision to defer, actually creates value within the real call option. There's also what is called follow-on investments, or follow-on. Let's say I build a phase 1 Mission Bay, in San Francisco, phase 1. Maybe there are other areas within the surrounding area of Mission Bay where we can build other medical or biomedical or educational institutional lab space. That follow-on is another option through the expansion process. That needs to be taken into consideration too. That expansion, either into new product lines or into new developments or new companies, adds value to the real call option. There's a change of operations. Instead of discontinuing the operations and taking a hit to the income statement in extraordinary items, maybe what you do is you change the operations and reuse the facility, thereby changing the character of the cash flows. So changing how you do business or a new product line. That again adds value to the real call option. And then abandoning projects also. Maybe we abandon the project. We'd save significant amount of costs, and we're not have to carry a loss division or a company that is deteriorating rapidly due to regulation change or due to hyper competition within the market space. So that decision again is a real call option that has value. And as I talked about earlier, the augmentation of the real call option value to the net present value analysis. Options are used in risk management to be able to hedge off market risk. So if I'm an oil company and oil prices go down 30% since October, I should have been writing forward in futures contracts and buying the puts on the futures and writing the calls on the futures to hedge off the decline in the market value of the oil, which is our revenue generating source. So these options and futures and forward contracts are used extensively by banks and corporations and other individuals to hedge off the market risks. Okay. So how much time do I have? 30 minutes? Okay, so let's do the 50. Okay, so let's do the homework problems. Why don't you bring me your memos and your Goldman Sachs PowerPoint presentation so I can take a look at it and give you some feedback. Give me the PowerPoint presentations first. Why don't you bring up the PowerPoint presentations first and then bring me the memos. then why don't we go around and do the, finish off the home. So who wants to show me their Goldman Sachs first? And then go ahead and do the presentations on the home. And make sure you record those too. So you came up with the whole.
Alright, so for number 4, question problem 20.3, it's about option payoffs. And the question asks, what is the payoff for a call option with the strike price of $50 if the stock price at expiration is $40? And then what if the stock price is $65? So the solution is if the stock price is $40, then the option will not be exercised and the option is considered worthless. And if it's $65, then the option is worth the difference between the price and the strike price, which is $15.
So question 28.4, pretty much the same thing. If the stock price is 40, and the option is worth the difference between the strike price and the stock price, 50 minus 40 equals 10. If the stock price is 65, the option is worthless.
Underlying asset of financial option is, for example, real estate. Something you need to think about when you're buying, applying a real option for a company is they do have other assets besides their service or product. They have real estate. Yep. 21.1, dollar cost of shoes. Take the cost of shoes, whatever currency it is, you multiply that by the rate of exchange, and then you get the cost in dollars of the product.
Oh, so here.
This is fine.
So,
Centered in the column, centered in the
here you have the cost of product and then how many products you have. So you
This is 3
times
years.
those together.
This is
Well, I think
cost.
I'm.
And over here we got the revenue.
Yeah.
And then you
And what I would
minus
do is I
the
would just do
revenue
the
from the
numbers.
cost, and then that gives you the additional revenue.
These actually flush This needs to be bigger.
Here, 11.75 per share. You can see the formula here. It's 11.75 per share. You have 3.9 billion shares. That's going to give you an answer here, and you're going to add 35 billion to that.
Okay, these are median.
We're going to come out with 80.825 billion.
Percentage changes over time. Over a 3-year
Thank you.
period. Yeah, sure, for 3 years. Like you did here.
For 18, 10,
So these are 3 years, these are 10.
you calculate the value of a share of the stock using the constant growth dividend model.
Yeah. So
That's
this
the first
is
part.
3 years.
Stocks values $13.89, and then you multiply that by the shares outstanding, which is 46 million. And then that's the total value of the equity, and then the total value of the firm is 988.94 million. So,
Nailed it.
Why did you use, where's the period?
So we have how much revenue right here, we have 40 million. And then right here we have how many, price per product, $5.05, times how many products, a million, 1.378.
You have to calculate the
So then we got 48 million. So that's our revenue, and we minus that from our cost. And you got 2 mil, full, trace.
Okay.
See if you ordered in the peer group.
So you got the present value of an asset, 123.65,
You can use the industry.
formula,
care about the industry.
1,536 million or 1.5 billion. And so the value of the firm is 541.98 million plus 1.5 billion is 2,078 million.
That is a lot.
And then if I calculate
Huge.
this,
Huge.
these need to be centered at around 16. These are the percentage changes. No, just the number. But this should be going.
Is it 19.8?
Huh?
Nobody teaching you.
Is it 19.8?
Yeah.
No, I did that.
This is
You did that?
No, I did 19.12.
just,
Oh, okay.
just this.
Oh, I thought someone was already
These need to be centered at just, should be centered.
That's why we got on camera.
Alright, for 19.12, you have assets of a little bit over 3 million, sales of over 5 million, and then what you're trying to find is the capital intensity ratio, so that's total assets over the net sales. So you would just put the number for the assets divided by the number of sales, and then you would get 0.636, which is approximately, well, which is 63.6%.
That's correct. I'm saying you're gonna have to just, you can't just copy the stuff like this and then present it. So in the middle of the meeting, they're gonna say, well, how did you come up with these? You know, there's premium usage and high.
Adobe from 19.
So the first thing we're gonna ask is a cruise and cruise will be 34%.
Payout ratio is 32% and the ROE is 13.7%. And to find the fallback ratio, you do 1 minus
Yeah.
the payout ratio, so it would be 60. And then the SGR would be ratio times the ROE,
Is he correct?
which would be 8.3.
Would ask you where you come from. Because the premiums seem to be.
What's that?
Stop it.
Yeah. No. Just leave it on. Just leave it on me doing my homework.
Yeah.
What I do is I use 2 decimal.
I don't think he's gonna want to upload 2 things.
No, yeah, that's what I was thinking too. Leave it forward.
People just hear us talking about that.
Go to bed.
What's the 50-year EPS? No. You have to have the EPS. Then you add these two together, divided by the discount factor, get that. If I add this up, I get that.
So this one is before at the.
That's correct.
Okay.
And then I would do that. There's too much, right? Unless you have one decimal here and you have 2 on there.
Yeah, so
I would just do 1 on these. Okay? Just use 1 decimal. Use 2. Yeah. Use 2, it's too much. And then I would get rid of the decimal points on these. We just round up. Make it-
for the X ones?
Yeah. You can do 1 decimal point if you want, but you gotta be consistent. So you don't have to.
So I should.
One or the other. Okay, and this needs to be, okay, so, see, I go right there. So this needs to be flipped. The one in the middle is the ones. And then make that a little bit bigger. Okay, that's the middle, like that. All of these, okay. These need to be centered in bold. Okay. And then these are wrong. And then these references, I don't know what the URLs are, so you have to give me the actual names. Because I don't know, I can't read URLs. 57 years old. Okay, and then these are wrong. Okay. Your projected premium of 31%. And you're telling me it's, that doesn't make sense. What are the 3 recommendations? What are the 3 recommendations?
Actually, I think maybe we should turn it off. I don't think he's doing anything.
No, for the recommendations.
Yeah.
What are the 3 recommendations?